Hello, and welcome to the Cascadia chapter of Credit Union's fourth part of our financial literacy series, Loans and Lending 101. My name is Arlo Harvey, and I am from Unitas Community Credit Union. As a refresher, who is the Cascadia chapter of Credit Unions? We are one of many credit union collaboratives focused on empowering members, credit union professionals, and the community. The focus of this financial literacy series is to provide key information to the public. Over the past month, we have covered fraud and prevention, credit building, and budgeting basics. Today, we will go through the fourth and final installment of our financial literacy series, Loans and Lending 101. I'm going to cover the most common types of loans in this course. We'll take a look at the different types of consumer loans, which will include auto loans, personal loans and lines of credit, and credit cards. Then I'll discuss different real estate loans with home loans and first mortgages, and then leveraging the equity in the home that you already own. Finally, I will go over some of the different options for repaying your federal student loans. But before we move further, I want to cover some of the most common terms that will apply to virtually every loan. First is debt to income, or DTI. This is the total amount of your debt compared to your gross income. The amount you make will affect your ability to repay the loan, and typically lenders will want to see this number stay under 45%. Next is loan to value, or LTV. This is the amount financed versus the value of the collateral. The value of the collateral will affect how much you are able to borrow, regardless of your credit worthiness. And when you are ready to apply for a loan, it is a good idea to be ready to provide proof of income, which may mean taxes in some situations. Additionally, you will want to make sure that your credit is not frozen. From a lending perspective, secured loans are going to be the safest form of loan. These are loans where you are offering up collateral in return for money. These loans that are secured by collateral are typically going to offer a lower interest rate compared to their unsecured alternatives. The most common form is the auto loan. Most lenders will have an array of rates and terms that will be based on three main factors: your credit score, the amount you are financing, and the age of the vehicle you are borrowing against. Typically speaking, the shorter the term, the lower the interest rate is going to be. However, keep in mind, depending on how much you are borrowing, if you shorten the term too much, the payment is going to be much higher. For example, let's take a look at a $15,000 auto loan. A lender could let you stretch the term out to 84 months. With an interest rate of 3.69%, the monthly payment on that would be $203. Now, let's take that same $15,000 auto loan and shorten the term to 36 months. The interest rate will drop to 2.44%, saving you more than a full percentage on the interest, but the payment will more than double to $433. Different lenders will likely have different names and groupings for how they classify RVs, boats, motorcycles, and ATVs, but you will be able to find loans on all of these products as well. These are going to work exactly like the auto loan, though lenders may have different requirements and LTV limits for these loans. There are also savings or CD secured loans. These loans allow you to keep the money in a CD or savings account and borrow against it at the same time. This allows that chunk of money to work twice as hard as it was originally, still earning interest in the savings account and giving you money that you need to spend. Now, let's touch on unsecured loans, which obviously do not have any collateral attached to them. A personal loan is a loan you take out from a bank or credit union based on your credit worthiness. The financial institution agrees to let you borrow a sum of money at a specific interest rate, which will depend on your credit history and your credit score. The amount the financial institution will let you borrow will depend on your income and other factors that will affect your ability to repay the loan in the agreed time period. Some of the most common reasons to take out a personal loan are debt consolidation. Taking out a personal loan to pay off credit card debt may be a good choice that can save you money, but be sure to double check the interest rate on the personal loan versus the credit cards or other debts you want to consolidate to make sure that you are paying less interest. Taking out a small personal loan and making regular payments on it may also help build or restore your credit, or there may be times when you need extra cash in a hurry, whether it be a family emergency, unexpected medical expenses, or you want to take a dream vacation with your family. Instead of a personal loan where you were given a lump sum up front, you may consider a personal line of credit. When you take out a line of credit, you are borrowing a sum of money that is available when you need it. When you use money from the line of credit, you repay what you borrow over time, paying monthly interest on the outstanding balance. Credit cards offer a different type of loan. Similar to a personal line of credit, this is a revolving line of credit, so you can use it to make purchases and only pay interest on the amount you use and the balance owed. Credit card interest rates will vary widely, so if you are looking for a credit card, you should make sure that the card is going to suit your needs, and you should consider the rate versus the other perks offered. Some cards will offer rewards points for every dollar spent, some will offer airline or travel miles, and some will offer cash back. Depending on what your needs are, those perks may be worth the higher interest rate. There are multiple types of home loans and mortgages that offer different payment terms. A fixed-rate mortgage is the most common type of home loan, as it is fully amortized and the interest rate remains unchanged for the life of the loan. This means that the principal and interest payment amounts are calculated as a fixed monthly payment, which makes it easier to accommodate to your monthly household budget. An adjustable rate mortgage, or an ARM, has a rate that will fluctuate with the market index. As the market interest rates go up, so does the interest rate on this loan. The Veterans Administration backs home loans specifically for veterans and service members, which can require little to no down payment, not require private mortgage insurance, and has other benefits. The Federal Housing Authority offers loans through banks and credit unions to first-time homebuyers and low-income families, where qualified applicants can borrow up to 96% of the home's value, and they offer more lenient credit requirements. You will need to meet specific criteria to qualify for a home loan. Most home loans are going to require a down payment of at least 20%. However, there are plenty of first-time home buyer programs that can require a significantly smaller down payment if needing one at all. Before you apply, you should calculate what you can afford. Some experts recommend the 28-36 rule, where no more than 28% of your gross income and no more than 36% of your monthly debt goes to a mortgage. You should also keep in mind that there will be additional costs, property taxes, and home insurance. Additionally, if you are putting less than 20% down, you will likely also need to pay mortgage insurance. There are multiple sources to get a home loan from. Your bank or credit union can underwrite a home loan, but there are also independent brokers as well. Once you find a lender, you should get pre-qualified, which will give you some verification from the lender that you will be approved for the specific loan amount. Then, once you find a home and are ready to make an offer, you should seek the pre-approval, which will include the lender running a formal credit check and taking the necessary steps for you to borrow the money. Once the home is purchased, it is likely to be your biggest asset. So you can also tap into the equity in your home, which is figured out by taking the value of your home and subtracting the balance on your current loan. Refinancing the home loan and using the equity in your home can give you extra cash to remodel, consolidate debt, or help in an emergency. This will keep one loan against your home, which means there is only one housing payment. Additionally, if the rates are lower than what you're currently paying, it could end up saving you a lot of money in interest over the life of the loan. If you are happy with the terms of your current mortgage and don't want to make any changes to that, you can also take out a second mortgage, which will give you one lump sum to use at your discretion. Another option is to take out a home equity line of credit or a HELOC. This is a revolving line of credit against the equity in your home. This will give you the flexibility to borrow what you need, when you need it, and only pay interest on the outstanding balance, similar to a credit card. There are 4 different types of federal student loan repayment options that you can choose from. Knowing what your goals are will help you make the decision that is right for you. But keep in mind, if you fall behind on your student loans, your credit will be negatively affected. The standard repayment lasts for 10 years, and if your goal is to pay less interest, this is the best option. The income-driven repayment option ties the amount you pay to a portion of your income and extends the length of the time you're in repayment to 20 or 25 years. When the term is over, the remainder of your debt is forgiven. This is best if you're having difficulty meeting your monthly payment and need something more manageable. Graduated repayment lowers your monthly payments at the start, then increases the amount you pay every 2 years for a total of 10 years. And the extended repayment plan gives you 2 options at a 25-year term. It can start payments out low and increase every 2 years like the graduated repayment, or you can choose a fixed version that splits the payment amount evenly over 25 years. This concludes Part 4 of Cascadia Chapter of Credit Union's Financial Literacy Series. We hope that you enjoyed this series, and we look forward to bringing more information to you in the future. On behalf of everyone in the Cascadia chapter, thank you for watching.